Welcome back to Investing Talk Podcast.
Today we're looking at Hecla.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
I think we have to start with the chart, right? I mean, you can't ignore it.
You really can't. We have to just acknowledge the obvious here. This stock has had just a powerful run.
Powerful is an understatement. We're talking well over 300% in the past year.
And hitting new 52-week highs right around that 21-wonder mark. It's, a textbook momentum breakout.
It is. But that's the big question for us, isn't it? Is there a real fundamental story that's backing this massive technical move?
That's the crux of it. When we look at the trading action, it's currently in a regime that some traders call the golden cross.
Right, where the short-term momentum is leading the long-term trend.
Exactly. It's trading well above its 50-day and 200-day moving averages. And, some of the analysis suggests we are in the early stages of a, quote, grand supercycle advance.
Wow, a grand supercycle. I mean, that's a very strong prediction.
It is. And it implies that any near-term volatility is really just a correction within a much larger multi-year uptrend.
With those long-term targets potentially reaching, what, $60 to $65 a share?
That's what some are saying. But we've also seen some pretty significant pullbacks.
Oh, yeah. Single-day drops of over 5%.
And that's even on days where the news flow was actually positive.
That tells us this is a high beta play, right?
Absolutely. Hecla is, at its core, viewed as a leveraged equity proxy for silver.
So when silver moves, this stock really moves.
It just amplifies everything, both the upside and the downside. So investors, you need to be prepared for that kind of volatility.
But those pullbacks are seen as buying opportunities.
Well, tactical entries on those dips are seen as pretty attractive risk-reward setups, at least within this larger bullish cycle.
Okay, so the technical picture is strong, but let's talk fundamentals. That strength has to be coming from somewhere.
It is, and it's coming from their incredible operational performance, especially in the third quarter of 2025.
It was a record quarter, I saw.
A record quarter. Revenue soared to nearly $410 million. That's up, a remarkable 67% year over year?
That is huge top-line acceleration. So what drove the profitability? Because, that's what separates a good mine from a great one.
It's all about operating leverage. The company's EBIT margin is sitting at nearly 30%.
30%.
And the Q3 results showed net income of about $100 million. Even more impressive, I think, was the adjusted EPS of 16 cents.
Which beat expectations, didn't it?
Significantly beat the consensus forecasts. It just underscores how effectively they're converting those higher metals prices directly into profit.
And what about the balance sheet? Because mining is, it's usually a capital-intensive, very debt-heavy business.
And this is maybe the key bull point. Hecla has gone through a major balance sheet transformation.
Okay.
They reduced their net leverage from 1.8 times adjusted EBITDA.
Which is getting up there.
Right, and they brought it down to just 0.3 times.
0.3, wow.
Management highlighted that this deleveraging saves them over $15 million a year just in interest expense.
And that just flows directly into future cash flow.
Exactly, so they're low debt, high margin, and, highly liquid.
So they have a strong balance sheet now.
They do. Strong liquidity, with a current ratio over 2.1. In Q3 alone, they generated $90 million in consolidated free cash flow.
And all the mines were cash flow positive.
All four of their key producing assets were FCF positive for the second quarter in a row. So they're paying down debt, paying a small dividend, and self-funding their growth projects.
Okay, so let's talk about the moat here. Why Hecla over other metals producers? It really sounds like they have a pretty unique position.
They do. First, they are the premier U.S. silver producer, and they have a 135-year history.
That's a long time.
It is. But their real moat is built on asset quality and jurisdiction. They operate in these Tier 1 North American locations like Alaska and Idaho.
Which lowers the political risk.
It lowers political and regulatory risk massively compared to a lot of their global peers.
Okay, Greens Creek, that's the crown jewel, right? Give us a nugget on that asset's performance.
Greens Creek is globally unique. In Q3, it generated nearly $75 million in free cash flow in one quarter.
$75 million.
But here's the crazy part. The cash costs were negative $8.50 per ounce after byproduct credits.
Wait, negative?
Yeah.
So you're saying they're literally getting paid to pull silver out of the ground when you factor in the zinc and lead they also produce?
That's exactly right. It is one of the world's most profitable silver mines, period.
That operational efficiency is just critical. And then we hear so much about silver's role in the whole green transition. How does that affect Hecla?
It provides a huge structural tailwind. I mean, silver demand is rising structurally. You need it in solar panels, you need it in EVs, electronics.
Everywhere.
And Hecla's scale and its North American concentration, that gives it this sort of quasi-scarce asset value for institutional capital that's looking for that clean energy metals exposure.
Okay, so we've got the bull case. We have to address the risks, specifically valuation.
Yes, we have to. After a 300% run, the stock trades at some elevated headline multiples.
Like a PE ratio around 75 times?
75 times, and a price-to-sales ratio around 10.5. I mean, this is significantly higher than many of its peers.
And that raises the risk of multiple compression, right, if silver prices just stall out.
That's where the conversation gets a bit difficult. If that metals rally reverses, the stock's high beta and that high multiple could lead to a really sharp decline.
We've even seen some cautious commentary coming out with some suggesting the stock is, no longer a buy after this massive surge.
Correct. And you also see that the average street price targets, they're sitting around $10 or $11.
Which lags way behind the current price.
Way behind. And that indicates there's significant skepticism out there that these current margins are really sustainable, that lagging consensus is a risk factor.
So what's the counter argument to that high PE? What is the long-term cash flow argument?
The counter-argument really comes from a DCF analysis, a discounted cash flow model.
Okay.
So when you factor in the projected free cash flow growth, which some models show rising to nearly $2 billion annually by 2035, the intrinsic value is estimated somewhere around $41 per share.
$41. So that suggests it might actually be undervalued by about 46% despite the high PE.
Exactly. The idea is that the high PE might just be a function of undermodeled future cash flow potential.
Interesting. So looking ahead, what are some of the key events that could drive the next leg of this rally?
There are a few. The most immediate one is the Investor Day in New York City on January 26th.
And that's a big deal because it coincides with the company ringing the NYSE closing bell for its 135th anniversary.
Right. It's a platform. It's designed for management to update investors on their long-term strategy, project timelines like the Keno Hill ramp-up, and their capital allocation plans now that they've deleveraged.
It's an event designed to reinforce that bullish narrative.
It is. And then maybe the most structural catalyst is the upcoming index inclusion.
Right, into the S&P Mid-Cap 400 Index.
And that is a material catalyst because it triggers forced passive inflows from index funds.
And it just increases their overall institutional visibility.
It creates a new structural demand floor for the stock. And all of this is happening right ahead of their Q4 earnings report, which is expected around mid-February.
And given their history of recent earnings beats, another strong report with some updated guidance could easily fuel a fresh surge.
It absolutely could.
So, wrapping this all up, what this all means for you is that this isn't just a mining story. It's a high-quality financial transformation story, and it's coupled with maximum leverage to a secular metal cycle that's being driven by green technology demand.
The risk is high, you can't deny that. The valuation and commodity volatility are real, but the potential reward backed by these exceptional assets and a fortress balance sheet is equally compelling.
It's definitely a stock to watch closely in this metals environment. If you want to keep up with these fast-moving markets, make sure you hit that subscribe button. We'll catch you next time.